My name is Farhan. In this video, you will learn to prepare an income statement for a sole trading business. This is question number 15 taken from 2020 Paper 1 exam. Rachel runs an online shop. She has provided you with a trial balance together with some additional information. Here you can see the trial balance has been given to us for the financial year ending 31 March 2020, and we have been given some relevant information that we need to take care of before preparing the income statement for the year ended 31 March 2020. So what we're going to do is first address each of the additional information that we're given, do all the relevant workings first, and then we can input all the information in our income statement. So starting with the first additional information, all goods are sold on a credit basis. What about information number 2? Revenue included goods on a sell or return basis. So if revenue included goods on a sale or return basis, which had been sent to a customer on 24 March 2020, these goods were invoiced at a selling price of £6,000 with a markup of 25% and were recorded in both the general ledger and receivables ledger. The customer returned the goods on 3rd April 2020. So what's happening in this case is that we have made a sale on credit to a customer, and the amount of the sale was £6,000. This sale took place before the end of the financial year, and this sale took place on 24 March 2020. Our financial year ends on 31 March 2020. We also know that the customer has returned these goods on 3rd April 2020. Although 3rd April 2020 falls in a new financial year, the return for the sales that has been made relates to the sales which has been done in this financial year ending 31 March 2020, and therefore must be adjusted appropriately when preparing the numbers. So starting with the revenue figure on the right hand side of the screen, we took the balance that we were given in the trial balance of £162,468, which is this figure here. And then from there, we subtracted £6,000, which was the value of the sales that we have made to the credit customer. And we get a net revenue of £156,468. The £6,000 here refers to the sales returns or the return inwards. And the final answer for revenue of 156,468 that we have refers to the net revenue. At the same time, because all goods are sold on credit, the trade receivables figure that was given in the trial balance would also need to be reduced by £6,000 because that customer who has returned the goods worth £6,000 in terms of sales does not owe us anything. So the trade receivables of £27,871 given in the trial balance, and then we subtract the £6,000 to reflect a reduction in our trade receivables, and we get a net trade receivables of £21,871. At the same time, the question also had other information with regards to markup of 25% when the selling price of the goods that was returned to us was £6,000. What we want to do here is to find the cost of goods that were returned to us, the cost that Rachel paid to buy those items for the business in the first place. Check the left-hand side of the screen. We know that markup is 25%, and if you take the cost and multiply 1 plus markup, you should get the sales, which means if you want to find the cost of the item that you have sold using algebra, you can find that by taking the sales and then dividing it with 1 plus the markup. Okay, so check the workings on the right hand side for cost of goods returned. So we know that the sales is £6,000 and the markup was 1 plus 25%, which is 1.25. So 6,000 divided by 1.25 gives us £4,800 for the cost of inventory that was returned to us by the customers, which means that when you prepare the income statement, you need to reflect this, which is increase the closing inventory by £4,800. Logically, this is because the customer has returned the items to us, and the cost of the items that Rachel paid for was £4,800, which means an additional £4,800 need to be included in the closing inventory, which reflects the fact that these inventory are those inventory that haven't been sold yet at the end of the financial year on 31 March 2020. Okay, so let's move on to additional information 3. Closing inventory was £19,267. This included items with a cost price of £925. However, they need to be repaired at a cost of £160 before they can be sold for £1020. So first of all, what we have to do is find the net realizable value for the items that need repairing. And the net realizable value can be simply calculated by the likely proceeds of the selling, which is 1,020, and then we subtract £160, which are the repair costs, and that gives us a net realizable value of £860 for these items that we can sell, for these items that we have to repair. We also know that inventory is always valued at lower of cost or net realizable value. The cost given in the additional information for the items that need repairing is £925. Based on our calculations, the net realizable value was £860, which is what we simply calculated by taking the likely proceeds from selling these items and subtracting the costs that we would need to repair these items, which gave us a net realizable value of £860. So when comparing the net realizable value of £860 with the original cost of £925 for this inventory, we understand that the lower is in fact the net realizable value, and that is what we should value this bunch of inventory at, which is £860. Therefore, on that basis, if you were to find the total for the closing inventory, we start with £19,267 that has been originally given to us in additional information 3. Then we add £4,800, which is what we did in the second step with regards to the cost of the items that were returned to us, and something that we have calculated using the markup formula. And we found the cost to be £4,800. That's why we're adding it back, because it's increasing the closing inventory. And then we are subtracting £925 to first remove the cost of the items that needs repairing, and then adding an additional £860, which is the net realizable value being the lower of cost and net realizable value, to get the final answer of £24,002 for closing inventory. You can expect something similar in exam to show up, so make sure you understand this very carefully. Let's move on to additional information number 4. Annual rent of £9,000 was paid to 31 May 2020. Okay, so we know that the financial year ends on 31 March, and if the rent was paid up to 31 May 2020, that means that rent has been prepaid for 2 months, and those 2 months are April and May, which comes in the next financial year. First of all, we want to find the monthly rent, and the way you can calculate it is take the annual rent of £9,000 and then divide it by 12, because we have 12 months in a year, which gives me £750 per month as the monthly rent. Then we're going to use the monthly rent as a basis to calculate the total rent that has been prepaid for next financial year for the months of April and May. So we take £750 and multiply it by 2, since 2 months of rent were prepaid, and we get the total prepaid rent to be £1,500. Okay. Prepaid rent is also known as the current asset. So if you were preparing the balance sheet under the current assets section, you would be including this £1,500 for prepaid rent, which relates to economic benefits that will be consumed in the next financial year. All right, so once we have found the total for the prepaid rent, what do we do next? For the rent and rates expense figure for the financial year ending 31 March 2020, which is our main concern in preparing the income statement, we take the £14,000, which is what we have got from the trial balance for rent and rates, as you can see here, £14,000 in the debit column, which is obviously an expense, and all expenses are debit. That is why it's included there. And from there, you subtract £1,500, which relates to prepaid rent, and you should get a final figure for rent and rates expense to be included in the income statement of £12,500. Okay, let's move on to point number 5. So the purchases figure included the purchase of some fixtures and fittings on 1 December 2019 at a cost of £12,000. So let's look into additional information number 5. The purchase figure included the purchase of some fixtures and fittings on 1 December 2019 at a cost of £12,000. The value for the purchases that we are given here should refer to purchases made for inventory only, which is given as £82,567. But what we understand is that this has been incorrectly treated, where the purchase of the non-current asset was mistakenly treated as purchase of inventory. So how do we fix it? First of all, the relevant purchases for inventory that we have been provided, which is £82,567 from the trial balance, we need to subtract £12,000 from there, and then we should get a net figure of £70,567, which relates to inventory purchases only. Then, for the fixtures and fittings at original cost, if you check the trial balance, you will see that the original cost is £96,000, and then you add the £12,000 that wasn't included before, and therefore the total fixtures and fittings would now be £108,000. Okay, then point number 6 talks about depreciation to be charged on a time apportioned basis using the straight line method at a depreciation rate of 20% per annum. So it's very straightforward, but we still have some complications here. So if you want to find the depreciation expense for the fixtures and fittings, given that we are using the straight line method, you're taking the original cost of $96,000 that we know to begin with, and then multiply 20%. But then there is another section towards it. We know that we have purchased an additional £12,000, which wasn't factored in. So 12,000 multiplied with 0.2, which is the same as 20%, and then we multiply a further 4/12. So why are we doing this? The question says to allocate depreciation based on the time it has been actually in use within the business. When was the fixtures and fittings of £12,000 purchased? On 1 December 2019, all right? And when are we preparing the income statement? For 31 March 2020. So what you have to do is count the number of months this £12,000 worth of fixtures and fittings were actually used within the business. So which is December 2019, which is January 2020, which is February 2020, and March 2020. So you have 4 months in total. So 20%, the rate that we know, is an annualized rate. How do we convert the 20% into a rate that is adjusted for 4 months? So that is what we have done here. So we did 4/12, which simply means that this asset was in use for 4 months out of the 12 months that we have in a financial year. So once you combine both of these calculations, you should get £20,000 as the depreciation expense for fixtures and fittings. Lastly, point number 7. A check paid to a supplier for £1,500 on 30 March 2020 had not yet been accounted for. All right, so this is an error of omission. So this wasn't included in the books at all. So what we have to do when we're paying a check to a supplier, it relates to the trade payables that we're talking about, who are the suppliers or the credit suppliers of the business. The value given for trade payables is £19,742. And from there, we subtract £1,500, because if Rachel is giving a check to the trade payables, then that means Rachel's obligation goes down towards the credit suppliers of the business, which in turn reflects a reduction in the amount for trade payables that we should have in the books. So £19,742 being the balance given in the trial balance, and we subtract £1,500 because a check has been paid to them, and we get a net trade payables of £18,242. At the same time, what happens to the balance of the bank? So the balance of the bank originally given in the trial balance was an overdraft in itself, which is why it is on the credit side. Because this is an overdraft, this is not we categorize as an asset, but rather a liability because the Rachel owes the bank money. And that is why, because it is a liability, it was included on the credit side to begin with. So a bank overdraft of 2,456 on the credit side simply means that Rachel has a negative balance in the bank account, which is minus 2,456. So if you were to find the final balance of the bank account, we start with negative 2,456, and then we deduct an additional 1,500, which relates to the amount that we have paid to the suppliers of the business. And we should have more deficit or more overdraft, which is £3,956 negative, which again refers to an obligation for Rachel or an overdraft, or the fact that Rachel has withdrawn more money from the bank than she originally had. Okay, so now that everything is taken care of, we can prepare the income statement, which should be very easy and straightforward. So we start with the revenue based on the format that we know of, which is £156,468, something that we have derived based on our calculations at the very beginning. And then we start with the cost of goods sold section. We start with opening inventory. So the opening inventory is given in the trial balance, inventory at 1 April 2019 of £16,276. Then we add the purchases for the year. This is the revised purchases figure of £70,567 after we have removed the £12,000 that should have been included for fixtures and fittings. Then we are subtracting closing inventory of £24,002. Where did we get this £24,002? This is based on our final calculations based on additional information 2 and additional information 3. And once you do all this, you should get a cost of goods sold of £62,841. Again, you can see this is in brackets, which reflects that the total for cost of goods sold will be subtracted from the net figure for revenue that we have. And when you do that, you should get a gross profit of £93,627. We also need to check for any other income that you can have during the year. So if you scan through the trial balance properly, you will see that we have something for discounts, which I've highlighted. So discounts are given on both the debit and the credit side. So what is the difference? The discount of 460 on the debit side refers to an expense, which is known as discount allowed. All expenses are debit, and the discount that is shown on the credit side refers to discount received, which is an income, and all income is credit. So discount received is a gain for Rachel because this discount is received from the suppliers. So that is why we look into this as a form of other income. Discount allowed is an expense that Rachel gives to the credit customers for prompt payment. So therefore, Rachel is losing some money when she does that. So that is why it is called an expense. Okay. So we are mainly concerned with the income part of the discount, which is the discount received of £820. And once we do that, we should get £94,447, which is the total for gross profit added with discount received. Then we take care of all the expenses that we have, starting with rent and rates. Rent and rates, the final expense is £12,500 because we had to remove £1,500, which refers to prepaid rent for the months of April and May in the next financial year. And you would be including that as part of the current assets section in the balance sheet or the statement of financial position. Then we have general expenses of £26,500. I've taken it straight from the trial balance because this didn't need any adjustments. Then we have depreciation of £20,000 for fixtures and fittings. Now I'm just going to quickly run you through this number again to make sure that you understand this. First of all, £96,000 was the original cost of the depreciation. Sorry, £96,000 was the original cost of the fixtures and fittings that we had been given in the trial balance, and then we multiplied 20%, which is known as 0.2. So those assets were in use throughout the entire financial year. We also know that we have purchased $12,000 worth of fixtures and fittings on 1 December 2019, and that must also be depreciated at 20% straight line method. But then we are multiplying 4 over 12. Why? Because from 1st of December 2019, which is the day the asset was purchased, until 31 March 2020, which is when we are preparing the income statement, we have 4 months of use. How do we know that? We have December, we have all of Jan 2020, we have all of February 2020, and we have all of March 2020. So that's 4 months in total. So that is why we are apportioning the 20% annualized rate by multiplying it with a further 4 over 12 to reflect the fact that this asset was used for 4 months. And once you combine both of them, you should get a depreciation expense of £20,000 for fixtures and fittings. So which is what we have included here. And then we have discount allowed of £460, which is what we figured out a while ago from the 2 balances that we were given for discounts in the trial balance. And then you add all of them together, you should get total expenses of $59,460. You can see I've put it in brackets, which reflects the fact that they need to be subtracted from the total income of £94,447. And once you do that, you get a net profit of £34,987. That's all for today's lesson. I believe you found a lot of value in this content. If you want, you can subscribe to this channel so that way you can get notified for more videos that I'll be uploading on a daily basis.